What's going on YouTube? Listen up, young elder gang. This is Ted Strokes, the billionaire at you with another banger. Please make sure you like, subscribe, and share this video, fam. I hope this video get at least 100,000 likes. In the following video, you will find history, definitions, scripture, information, and best of all, what we Americans have been deprived of from the beginning, the truth. Keep in mind, this content used in this video is intended for educational and informational purposes only. We will give you the total truth as we best understand it today. Be sure to hit that like button, young elder gang. Hit that subscribe button if you're new to the channel. Hit that bell and don't forget to check back with us every day for new content. Alright, let's get started. The main difference between credit unions and banks is their ownership structure. Member-owned, non-profit cooperatives that prioritize member service. Credit unions are owned by their members, who have a say in how the credit union is run. Profits are reinvested into the credit union or returned to members as lower fees or better interest rates. For-profit institutions owned by private investors or shareholders. Banks' primary goal is to maximize profits for their investors, which can sometimes influence their policies and service offerings. Credit unions require membership, while banks do not. Banks have more access to branches and ATMs, but credit unions offer better deals on rates and fees. Larger brick-and-mortar banks generally have advanced technology, but smaller banks might not. Banks emphasize business and consumer accounts, and many provide trust services. Credit unions emphasize consumer deposit and loan services. Research shows credit unions are less likely to fail compared to banks during recessions. When choosing between a bank or credit union, you can consider what you value. For example, if you value technology and access to in-person services, you might prefer a bank. If you value better rates and customer service, you might prefer a credit union. While banks are open to the general public, credit unions have membership requirements that help them provide personalized, community-oriented financial services. On the surface, banks and credit unions look to offer the same thing. They provide a myriad of financial products to cater to their clientele. For both, you can open a savings account, take out a loan, or apply for a line of credit. The similarities often draw questions as to why each doesn't identify with the other. There are actually a lot more differences than what you see on the surface. Examining these different aspects can give you insight into what institution to choose. Here's what you need to know about the difference between banks and credit unions. Banks are the most common financial institution everyone has likely encountered before. They offer different financial products to their customers. A common experience is opening a bank account to save money or receive a salary from your workplace. While banks provide distinct products to help their clientele, there is one thing you should never forget about them. Banks are for-profit institutions, meaning they engage in business to earn money. This is why you encounter interest rates, fees, and the like. Banks handle large amounts of money and provide convenience for their clients in exchange for payment for their services. But investors, owners, and shareholders are the ones reaping the rewards from the net profits. Because banks operate to gain profits, they change policies and services to what they think will be better for their future. Clients do not have a say in how a bank changes, though most changes don't generally affect them. Sometimes the bank may increase fees, run promotions to attract clientele, or open new branches in other locations. There are several benefits to using banks. The biggest of all is their presence. Banks have multiple locations in your area, and many have national branches. That means it's easy to transact with them, and they also have ATMs to withdraw money from numerous locations. Here are some other things you'll likely find in a bank. Banks use the latest technology to give them an edge over other banks. They adopt things such as online and mobile banking, credit, debit cards, and more. Banks offer specific programs and products that cater to businesses. Some programs may cater to different personal needs depending on what they decide to offer. One example of this is bank accounts for employees of a specific company. There are more investment options available with banks as they want to attract all sorts of customers. You can open an account for investing in bonds, stocks, mutual funds, and retirement funds. Bank and credit unions have several similarities and differences to consider. Both offer the same general services, such as checking and savings accounts, as well as various loan options. Your deposits in both credit union and bank accounts are federally insured for up to $250,000 per account holder. Banks and credit unions usually have different ownership models. Banks tend to be for-profit institutions owned by shareholders that offer banking services regionally or nationally. Conversely, credit unions are usually nonprofit entities owned by their members and serve their local communities. However, you will find differences in fees, interest rates, product offerings, convenience, and customer service, although each financial intuition differs. Credit unions tend to offer lower fees and interest rates on loans and credit products, as well as more personalized customer service. However, banks may offer more variety in loans and other financial products and more extensive networks that can make banking more convenient. You'll often find a credit union in your local community. This is because these are financial institutions that cater to an area, a specific industry, or a group of companies. Similar to banks, they offer products like savings accounts and loans. The biggest difference between them and banks is that they are non-profit financial institutions. Credit unions were created for their members, and it's also these people who maintain them. Every product and service a credit union offers is a result of voting. Members are also the ones responsible for keeping the credit union running by being its clientele. The financial institution only takes enough money to keep operating and never for additional profit. As such, any changes or upgrades made in credit unions are foremost the decision of its members. They are also the ones that help fund the conveniences or products they want to add. Clients always have the final say because they are the credit union's stakeholders. The majority must agree before the credit union does anything. The biggest benefit of credit unions is their interest rates for loans. Most of their products have lower interest than banks because they don't need to profit from these transactions. Another reason why people like them is because they are a local community bank. A local financial institution with low interest for loans can benefit businesses. Credit unions don't require membership fees or monthly charges either. There are some exceptions, but credit unions usually gain the money they need through other fees and interest rates. They encourage people within their vicinity to open accounts with them and become members. Another thing you'll notice with credit unions is their savings products have higher interest rates for earning. That means you'll generally gain more for saving money in a credit union savings account than you would in banks. Banks or credit unions? While there are specific benefits with each, it also means that each comes with challenges for its clientele. Credit unions don't have the variety of products and services that banks offer. They also have limited physical branches and ATMs. Accessibility may be an issue when you're traveling to another location. Many credit unions have begun adopting mobile and online banking technology, but they're not as robust as those you would find in a bank. On the other hand, you'll save a lot more money with loans and earn more in savings products in a credit union. Banks generally charge higher because they have to profit. That means higher interest rates with loans and lower interest with savings. Banks also have strict rules and requirements before opening their products and services to clients. Credit unions are a lot more flexible and personalized because they focus on the members they have. Both banks and credit unions have financial authority with the full trust of the U.S. government. That means these institutions have insurance and protection for their clients in case of bankruptcy. Choosing one or the other depends on what you find the most advantageous. Those who want more banking products and nationwide access may choose to open accounts in banks. On the other hand, a local business that wants better loan terms and flexible requirements may choose a credit union instead. It's all about your personal needs and preferences. Commercial banks or retail banks may be owned by investors or privately owned. Banks operate as for-profit institutions. Anyone can open an account with a bank, whereas credit unions have membership requirements. There were 4,026 FDIC-insured commercial banks with roughly $22.5 trillion in assets as of December 31, 2023. Banks can range from one-branch community banks to larger regional and national banks. Credit unions are not-for-profit financial institutions owned by their members. They provide many of the same products and services as banks, including checking and savings accounts, as well as various loan products and investment accounts like IRAs. Deposits in credit union accounts, like with banks, are federally insured for up to $250,000, but by the National Credit Union Administration, NCUA, instead of the FDIC. More than 140 million people belong to a credit union. Credit union members can vote on credit union policies and participate in decisions. According to an NCUA 2023 annual report, latest report, 4,604 federally insured credit unions held assets of around $2 trillion. Credit unions must limit their customer base to an NCUA-approved field of membership, such as a workplace, school, place of worship, or geographic area. National credit unions want to increase membership, so they may offer broader fields of membership, such as accepting members of a specific organization, large company, or broad geographic area. Credit unions' profits are returned to members through benefits such as lower fees and better interest rates. According to CUNA estimates, the financial benefits provided to credit union members are equivalent to $179 per member or $376 per member household. Credit unions were initially developed to provide limited banking services to moderate-income people within a narrow field of membership. As a result, credit unions are exempt from federal income taxes. Should I choose a bank or a credit union for my banking needs? The decision between a bank and a credit union for your banking needs depends on several factors. Here are some things to consider. Membership. Credit unions are member-owned organizations, and you must be a member to use their services. Banks are for-profit organizations that are open to anyone. Interest rates. Credit unions often offer higher interest rates on deposits and lower interest rates on loans compared to banks. Fees. Banks tend to charge more fees than credit unions, such as monthly maintenance fees, overdraft fees, and ATM fees. Customer service. Both banks and credit unions offer customer service, but credit unions are often known for having more personalized and local service. Products and services. Banks generally offer a wider range of products and services such as investment and wealth management options. Convenience. Banks often have more branches and ATMs, which can be more convenient if you frequently travel or need access to cash. It's important to consider your individual financial needs and priorities when deciding between a bank and a credit union. Consider shopping around and comparing the fees, interest rates, and products and services offered by each before making a decision. Banks make money in a number of ways, including interest rate spread, the difference between the interest rate paid to depositors and the interest rate received from borrowers. Banks profit from this spread. Banks charge fees for a variety of services, including checking accounts, financial counseling, loan servicing, selling financial products like insurance and mutual funds, out-of-network ATM fees, overdraft fees, insufficient funds fees, paper statement fees, inactive account fees, account closing fees, securities trading. Banks earn income from trading securities. Investment banking. Investment banks provide advisory services to corporations and governments and raise capital by selling securities. Banks earn an average of 1–2% of their assets, also known as their return on assets, ROA. Commercial banks make money by providing and earning interest from loans such as mortgages, auto loans, business loans, and personal loans. Customer deposits provide banks with the capital to make these loans. This means that if a bank has $100 deposited with them, they can loan out $90 because they only need to keep 10% of that deposit as a reserve, essentially allowing them to loan out 100 on 10 inches based on the concept of fractional reserve banking. Explanation: fractional reserve banking. Banks are allowed to lend out a portion of their deposits, not the entire amount, by holding only a fraction of the deposited money as reserves. If a bank has a 10% reserve requirement and someone deposits $100, the bank keeps $10 as reserves and can loan out the remaining $90. This system allows banks to create new money by lending out funds that are deposited with them. The amount a bank can loan out depends on the reserve requirement set by the central bank. The money multiplier effect occurs when the loaned money is deposited in another bank, allowing them to further lend out a portion of that deposit. Most banks are a pyramid scheme. A pyramid scheme is a fraudulent business model where individuals make money primarily by recruiting new members into the system, rather than selling a product or service, meaning the majority of participants lose money while only those at the top of the pyramid profit significantly. It's considered illegal due to its reliance on recruitment over genuine sales activity. Key points about pyramid schemes. Focus on recruitment. The primary way to earn money is by bringing in new recruits, not by selling products to customers outside the scheme. Hierarchical structure. Participants are organized in a pyramid structure, with those at the top benefiting from the payments made by those below them. Early birds benefit most. The first few people to join often make the most money, while later participants struggle to recruit enough people to cover their costs. No real product or service. Often, the product sold in a pyramid scheme has little real value and the focus is solely on recruitment. How to identify a pyramid scheme? High pressure to recruit. Strong emphasis on signing up new members quickly. Promises of quick riches. Unrealistic claims about potential earnings with minimal effort. Buy-in required. Participants need to pay a fee to join the scheme. Complex compensation structure. Difficult to understand how earnings are calculated with a heavy focus on recruitment levels. Banks are involved with the Federal Reserve System in a number of ways, including holding stock in reserve banks. Member banks are required to hold stock in the reserve bank in their district and receive dividends. However, unlike public company stockholders, banks cannot sell or trade their Fed stock, keeping reserve balances at the Federal Reserve Bank. Private banks keep reserve balances, also known as Federal Reserve deposits, at their local Federal Reserve Bank. This allows banks to lend funds to each other, which is a key part of the Federal Reserve System's monetary policy. Borrowing from the Federal Reserve banks can borrow from the Federal Reserve through the discount window to manage short-term liquidity needs, being examined by the Federal Reserve. The Federal Reserve examines banks to ensure they comply with consumer protection and fair lending laws. Examiners also issue banks a rating to indicate if they are in good shape or need corrective action, providing financial services. The Federal Reserve banks provide financial services to the nation's payment system, such as distributing cash and coin to banks and clearing checks. The Federal Reserve System is made up of 12 reserve banks, each operating within its own geographic district. The reserve banks are supervised by the Federal Reserve Board but operate independently in many ways. To start your own bank, you need to thoroughly understand the banking industry, develop a comprehensive business plan, secure significant capital, obtain a banking charter from the relevant regulatory body, apply for necessary permits like FDIC approval, build a strong team, and attract customers by identifying a niche market and providing valuable services, all while adhering to strict compliance regulations throughout the process. Key steps to starting a bank: market research and niche identification. Assess the local banking landscape to identify potential gaps in services or underserved communities. Determine your target customer base and the specific banking products you will offer. Business plan development. Create a detailed business plan outlining your bank's concept, mission, financial projections, marketing strategy, and operational plan. Include information about your management team, expected revenue streams, and potential risks. Legal and regulatory compliance. Consult with legal and financial experts to understand the necessary licenses and permits required to operate a bank in your jurisdiction. Apply for a banking charter from the appropriate regulatory authority. Comply with capital adequacy requirements and other banking regulations. Funding and capital acquisition. Secure significant capital from investors to cover startup costs and meet regulatory requirements. Explore options like private equity, venture capital, or personal investments. Team building. Hire experienced professionals in banking operations, compliance, risk management, marketing, and customer service. Assemble a strong board of directors with relevant industry knowledge. Technology and infrastructure setup. Invest in robust banking software and technology systems to manage accounts, transactions, and compliance. Establish secure data storage and cybersecurity measures. Location and facilities. Find a suitable location for your bank branch, considering accessibility and customer convenience. Design and equip the branch to provide a positive customer experience. Marketing and customer acquisition. Develop a marketing strategy to attract new customers and promote your unique value proposition. Build relationships with local businesses and community organizations. Important considerations: high barriers to entry. Starting a bank is a complex process with significant financial and regulatory hurdles. Strict compliance banks are subject to stringent regulations and ongoing compliance requirements. Risk management. Implementing robust risk management practices is crucial to mitigate potential financial losses. A household is considered unbanked when no one in the household has a checking or savings account at a bank or credit union. Unbanked individuals use alternative means to manage their money. The FDIC breaks down data of unbanked households, showing that of the total population surveyed, 4% of households are longer-term unbanked, meaning they haven't had a bank account for at least a year, and 0.5% are recently unbanked, meaning they did have a bank account within the last year. About a fifth of those recently unbanked cite losing a job or a significant portion of income as the reason for closing their bank account. Meanwhile, the top-cited reason among all unbanked households for having no bank account is not having enough money to meet minimum balance requirements. When it comes to race and other demographics, the percent of households that are unbanked varies significantly. Underbanked households are those that do have a bank account but have to rely on non-bank financial services for certain banking needs, such as getting loans or a credit card. About 14.1% of U.S. households, or 18.7 million in total, are underbanked, according to the FDIC survey. Those who are underbanked may have limited access to their bank accounts or limited transactional capabilities. Only 38.1% exclusively used their bank account for paying bills or receiving income, compared with 81.6% of fully banked households. Underbanked households are also more likely to take out non-bank personal loans. Consumers with a history of unpaid overdraft fees or bounced checks may be blacklisted from opening a new deposit account. If you're unbanked, you may have a bad check systems report due to some financial setbacks or stumbles, says Bruce McClary, Senior Vice President of Communications at the National Foundation for Credit Counseling, NFCC. What you should do: explore options designed to give you a second chance. Some banks offer second chance accounts, which are geared toward those with a poor credit history. Chime and Wells Fargo are two of the most well-recognized national names that offer accounts for those who have struggled to open a traditional checking account. You might also look closer to home and compare options at smaller institutions in your community. There are community banks and credit unions that have creative programs to provide a pathway toward restoring your relationship or creating a new one with a bank or a credit union, Young Elder says. Some banks have made headlines for selling customers products they don't need or creating fake accounts for customers in the name of earning a profit. If those behaviors have made you skeptical of banks, you're not alone. 33% of unbanked consumers in the FDIC's latest research say that they don't trust banks. What you should do: trust the system. If you do not completely trust banks, you can trust the systems in place that hold banks accountable for their actions, McClary says. With the banking industry, there are a lot of regulations and rules. There are consequences if a bank breaks those rules that protect consumers quite well. You can work with a bank knowing that your interests are protected. You have recourse if a bank breaks the rules and causes financial harm. One of the regulators that keeps banks in check and protects consumers from being exploited by them is the Consumer Financial Protection Bureau, CFPB. If there's an issue with your bank, you can submit a complaint to the CFPB.